Talk to me about our productivity. It's unusually poor. This is the basis upon your report. Why? Yeah. Why are we in that position?
I mean, it's been, as I say, the defining characteristic of the post-crisis economy. It's been poor, not just in absolute terms, but also relative to other advanced economies. It's been, and particularly the US, the so-called technological frontier, has continued to progress, and the UK has fallen further behind. It's our view that, you know, one of the key themes of our research has been that the problems with the UK banking system have been really instrumental in explaining a lot of the post-crisis puzzles, and I think particularly the productivity puzzle. Why? Because the banking system plays a crucial role in allocating capital to the right sectors.
Yep.
Because of the problems within the banking system subsequent to the crisis, capital hasn't been, or resources haven't been allocated to the sectors where it's needed most. Now, it's our view that, you know, that the FLS and the measures that were taken to help the banking system have initially boosted growth, and in time they will help to boost productivity as well. So it has been very bad in the past, but we think, I mean, it's our thesis that it will improve in the future.
So we're beginning to reallocate resources from the banking system, lending to the real economy, as you say. It's getting to the right places. What does that do to our productivity story? Will we catch up with the US? What does it mean for me as I look at the UK economy, if I try to translate the theory of productivity into what's going to happen in our economy as you take that forward?
Well, it means a couple of things. I mean, you're absolutely right in terms of the UK has fallen further behind the US, and actually that makes it easier to catch up in some sense. It may sound counterintuitive,
no, go on.
But the poor performance in the past makes it easier to grow faster in the future. You know, the UK prior to the financial crisis had 40 years where convergence was taking place. All else equal, given how much it has fallen behind the US now since the crisis, that, on our estimates, is likely to make productivity around a third to a half a percentage point faster per year because it has fallen behind. Now, what does that mean for policy and for the economy going forward? Well, for the Bank of England, if we are right on productivity and productivity begins to improve, then it means that, all else equal, the Bank of England can tighten later and at a slower pace than they would otherwise have to.
Which takes us to, very nicely, thank you very much, to the great debate. You know, Spencer Dale says that they're comfortable with the central judgment that there's slack in the economy. They reckon that the slack in the economy is about 1.5%. So our rate hikes, are we all far too far ahead of ourselves in terms of a rate hike spring of 2015? I mean,
our view is consistent with our analysis on productivity, on the output gap, spare capacity, which we think is pretty substantial. Our view is that the Bank of England won't begin to raise rates until the Q3 of 2015. So we're, you know, behind, more dovish than most analysts. And I think this productivity question is the key uncertainty that the Bank of England is grappling with. We are, you know, on the optimistic side, but we need to see how things evolve going forward. I'm comfortable with the view that as things stand now, I think the risks are somewhat towards an earlier hike than we currently have within our forecast. But nevertheless, I'm happy being dovish relative to the market.
Okay, I mean, you're not that far away from the market, so to speak. In terms of the overall position for, let's say, our economy, we've had a review by the Bank of England just a couple of weeks ago. Phase 1 guidance has ended. We've now entered into Phase 2. But some of the data, and just in the break you said actually, the unemployment ticked up, inflation is ticking down. Give me your take. Maybe things just aren't as robust as everybody else makes?
No, well, I mean, the activity data remains very strong, and we are also above consensus on growth. But it is interesting that since the February inflation report, where they introduced Phase 2 of guidance, which would come into play when the 7% unemployment threshold was reached, we've now had unemployment, as you say, has risen from 7.1 to 7.2. By the time we get to the May inflation report, we think it'll still be above the 7% threshold, which would imply that phase 1 of guidance will still be in place. Inflation has fallen below target for the first time since 2009.
Right.
And we expect by the time of the May inflation report, it'll be down at 1.5%. I mean, that is now a long way below target. So, we could be sizing up for having, been very hawkish, or at least the market being pretty hawkish around the February inflation report. By the time we get to the May inflation report, things could look a lot more dovish. And as it relates to, this meeting, however, we don't expect any dramatic changes.
Very, very briefly, Mark Carney's phrase that rate hikes will be limited and gradual. Do you concur with that? That when they come, they will be moderate and limited and below that 5% historical level? Yeah,
no, 100%. I mean, the fact that credit spreads are much higher now than they were before, I think some of that will reduce over time. But, I do think that, we're not going back to the pre-crisis era of very narrow spreads.
Yes.
So, all else equal, that will mean that the equilibrium rate of interest is likely to be lower than it was before the crisis. Now, what we also believe is that, although rate rises will be gradual, we also think the first rate rise won't occur for some time. So, we're dovish both on the speed with which they are likely to rise, but also the timing of the first hike.